Welcome to Yahoo Finance Live. I'm Shauna Smith along with Diane King Hall. The June jobs report being released right now, coming in below expectations. Non-farm payrolls, number of jobs added to the U.S. economy last month, 209,000. That was below the general consensus here for 230,000. Taking a look at the unemployment rate, that coming in line with expectations, 3.6%, ticking down from 3.7% the prior month. Average hourly earnings, a month-over-month basis. We know this is a key metric for the Fed. That was up 0.4%, so a bit higher than what the street was looking for. Average hourly earnings on a year-over-year basis coming in at 4.4% here, Diane.
So it is interesting to see this number. Surprise even me, especially when you consider ADP's numbers, which blew well past expectations yesterday at nearly 500,000 private sector payrolls. So I was expecting a bigger jump, and we even saw Goldman ratchet up their expectations to 250K for this number. So again, coming in light when you consider that, and you're seeing a little bit of a reaction in terms of futures because we saw stock slide yesterday responding to the ADP report, which, started to kind of support that notion of the Fed moving forward on another potential rate hike. So.
Yeah, exactly. And I think a lot of this in terms of the market reaction that we are seeing, good news is not necessarily good news here for the equity markets in terms of how we have seen the reaction from investors, because of course this came in as a very hot report, making it more likely that the Fed is going to continue to raise rates. So the fact that this was below expectations, 209,000, certainly something to know, and a big reason why we're seeing the reaction in the futures markets right now.
Yeah, indeed. And, when you look at just kind of the breakdown, the unemployment rate, as you mentioned, a little change at 3.6%. So that was in line with expectations. I know there were some talk of it possibly ticking up. The number of people employed part-time for economic reasons did rise by 452,000 to 4.2 million. In June. So there's a little bit of an uptick there, just showing an increase in the number of people whose hours were cut, due to possibly business conditions, obviously. So we're definitely seeing a change there. And for more on these jobs numbers, I want to bring in a couple of our panel guests. We have Dana Peterson of the Conference Board and Stephanie Roth of JP Morgan Chase Private Bank, Senior Markets Economist. So Stephanie, let's get right to you. What's your initial reaction to these numbers?
Initial reaction is better than what was feared yesterday, because the market doesn't really want jobs to be overly strong, because that really puts a pressure on the Fed to hike even more. But it still was a firm report. I think we have to remember that it still was a print above 200,000, which likely puts the Fed hiking in July, and it still keeps the door open to more hikes after that. A couple of other things that I noticed from the print: there was some downward revisions, 100,000 to the prior 2 months. So it definitely was a little bit softer than expected, except for the wage numbers. That beat by a little bit. So it's important to keep that in mind, that the Fed's likely to hike again, and it'll be data dependent from here.
Dana, how do you think the Fed is looking at this report, given the fact, like Stephanie just said, it's still above 200,000?
Absolutely. 200,000 jobs added is still very strong. The unemployment rate is very low. I haven't seen the detail, but I would imagine you're still seeing a lot of churn, especially in leisure and hospitality and healthcare, those sectors that are still facing labor shortages. And let's not forget the fact that wages are still very, very elevated, and they are being influenced by prices. And we received the PCE deflator data last week, and the core deflator is still very sticky. It's still being lifted by those core services as well as housing.
So, Stephanie, I want to just ask you what your reaction is, especially when you dig deeper into this, when you look at the number of people employed part-time for economic reasons. Does that give any cause for concern in terms of just kind of the path of jobs in the job market?
Yeah, so I mean, we're starting to see some gradual softness, some softness under the surface, and I think that's important to sort of keep in mind, that the Fed is trying to slow down the economy. They're having some signs of that. It's just the economy's been proving to be a little bit more resilient than would otherwise be the case. But we are getting a gradual softening in the labor market. It's just taking a lot longer because businesses are still operating in a solid nominal growth environment.
Dana, when you take a look at that average hourly earnings month-over-month basis coming in slightly above expectations, 0.4% of a gain there, 4.4% on a year-over-year basis, you would think that that's still too hot for the Fed when the Fed is trying to get inflation under control. What does that number need to be in order for the Fed to be a little bit more comfortable with what the inflation outlook is going to be? Are we talking flat? Are we talking 0.1%? I mean, how high or how disappointing is a number like the print we got today?
Well, I think, anything that's flat or even negative, that would signal that there's cooling in wages. But again, we have these severe labor shortages, and many businesses, when we talk to them, the first thing they do to attract labor and also to keep labor is raise wages and increase benefits. And indeed, our own survey suggests that over the next 12 months, CEOs are still looking to raise wages by anywhere from 3 to 5%. So that's really steep, and we're probably going to continue to see that played out in the payrolls data.
So we saw some growth in certain sectors, obviously. We saw some growth in healthcare, adding, what's that number? Oh, my eyes. In the payrolls report. It's always such a tiny print, 41,000 jobs in June. So, some growth in healthcare. That was also different than what we saw in the ADP report yesterday. Government added jobs. Construction actually trended up. I guess that's a sign of kind of the just still being in the summer months and hiring there. Is there any sector that concerns you, Stephanie? I mean, we saw little change in professional and business service. And I know in general, the services sector, leisure, hospitality, little change. There was concern or has been concerned about from some economists and industry watchers about the services sector and how long it can hold up. What stands out to you as that may be potentially concerning?
Sure. So, well, first of all, the private sector jobs added just 149,000. So that's quite a bit of a slowdown from where we were, which was well above 200,000 the prior month. So you did get a bit of that cooling there. You did get a little bit of job losses in retail, in trade and transport. These are some sectors that actually overhired during the pandemic. Right. So it kind of makes sense that you're getting a little bit of softness there. There are a number of sectors that were benefiting specifically because of COVID, and you're getting some sort of pullback there. Technology is the most obvious, and finance, but there are some other sectors that are feeling that. And like Dana talked about, there are other sectors that are specifically within leisure and hospitality that are still seeing a strong demand for labor because they're still understaffed.
Dana, the average weekly hours that all employees have worked, and I know that was a key data point that you were looking at, that was actually ticked slightly higher, 34.4 hours, up from 34.3 the prior month. You were looking at that just in terms of if we did see a decrease, what that could signal for job cuts. What does this mean now, the fact that we did see a slight tick higher? Is that reassuring just in terms of maybe those job cuts would be pushed out a little bit, and reassuring to employees out there?
Well, a key thing is that when we ask CEOs what they're doing with their labor, 46% say they're not going to do anything. They're not hiring. They're not letting people go. They're hoarding labor, but they are reducing hours. So it didn't really show up that much in this report, but that's what we're hearing. And certainly that's a trade-off. Certainly, instead of letting people go, just letting them work fewer hours so you can hold on to them. And that's really because a lot of CEOs think, yes, there's still something on the horizon that may be negative, a recession or a soft spot, but it's going to be short, it's going to be shallow. And oh, by the way, we don't want to have to turn around and rehire labor if that's the case.
Stephanie, so when we hear that they are reducing hours, does that kind of match up with what your expectations were coming into this report, downtick in terms of the hours?
So coming into this report, I think I had to be a little bit concerned with the market yesterday, just because ADP did have such a big beat, and ADP's track record has been quite poor. But it just was another data point alongside a number of the ones that we've seen over the past couple of weeks that have been strong. So heading into this report, I wasn't necessarily expecting to see material signs of softness. Another thing that did pop out to me is that temp employment declined 13,000 on the month. That's another sector similar to the concept of hours that Dana talked about. That's another area that you tend to shed labor first. It tends to be a leading indicator of maybe some employment to come. So we do think that we'll see some softening over the course of this year. Our base case is the economy slips into recession towards the year end, but odds of a soft landing have gone up over the past couple of months.
What do you think, Dana? Do you agree with that, just in terms of the odds of a soft landing? Is that something that's still on the table? And what does that recessionary risk look like?
We still have a recession priced in, probably starting right about now in the third quarter, per our leading economic indicators, and also when we ask consumers and businesses what they think. We still think that the Fed has maybe 1 or 2 more rate hikes in its pocket, That won't cause a deep recession in our view, but still in all, we're looking at a soft spot here. I think that the risk that you do have a soft landing may have gone up a little bit, but the key thing is going to have to be inflation, and certainly in the labor market, seeing cooling there.
And Stephanie, remind me your expectation, 1 or 2 more rate hikes, and does this print today change that?
So we officially think 1 more hike, possible that there's another one after that. Our base case is that job gains have to slow to well below 200,000 in order for the Fed to be pausing. So this doesn't really accomplish that. We need further prints that are below the 200,000, but at least it's cooler than what was expected as of heading into the print.
Stephanie, what does this mean for investor positioning? How should they be prepared for the fact that we could see some more volatility here in the months ahead?
So we're certainly recommending that clients take advantage of structures. That's especially since a lot of our clients are concerned. That's a good way to take advantage. But a lot of our clients are overweight cash, and it doesn't make sense to be sitting here on the sidelines doing nothing. Cash over time is a big underperformer. So we think clients should get invested. There's a lot of opportunities, things like mid-cap equities that are a little bit more supportive from a valuation perspective. Things that are international, European equities have a bit more valuation support. And then, of course, adding from cash to core duration fixed income. So there's definitely a lot for clients to be doing. Sitting in cash is likely to be a losing strategy over the next 12 months.
And Dana, I want to ask you, are there any other data points outside of jobs that are concerning to you that kind of add credence to your view about us actually basically being on the precipice, if not in a recession already?
Sure. Well, I look at the JOLTS data, and we're not really seeing any improvement there in terms of vacancy shrinking. So I think that's a signal that the Fed still needs to keep going. And the more the Fed raises interest rates, the greater the likelihood we're going to go into recession. We're also very concerned about student loans. So certainly many people have experienced some relief over the pandemic. If they have to start, well, most likely they will have to start repaying back those loans. It's going to reduce the amount that they can spend. And that's actually bad thing for them, but a good thing for the economy if that could help bring down inflation. But certainly, again, looking at our indicators, our leading economic indicator has been negative for 15 out of 16 months, and it's very negative, and usually that signals recession.
Right.
So, Stephanie, then what is it, one of the sectors that you did not mention there in terms of the opportunity, consumer discretionary, and bring that up on the heels of what Dana was just saying about the consumer, the fact that we are starting to see some cracks because the consumer had been holding up very, very well over the last several months. We're beginning to see a pullback. What does that mean for those consumer discretionary stocks and some of the shorting activity that we're seeing going on there?
Yeah, so the consumer is likely to be the next thing that softens in this economy. It's held up very well. You've seen slowdown in the manufacturing side of the economy. You've seen housing take a big hit. It's likely to be the consumer that's the next leg to soften, especially because it's driven by a strong labor market. And we're all talking here about the Fed is trying to cool down wage inflation, trying to cool down the labor market. So that's likely to be the area that would see the softness looking ahead.
And Dana, one last takeaway for you. What's your or the big picture from this print today?
Big picture is that I think this is still more fuel for the fire for the Fed to go. Most likely July, even though they keep talking about lags. It seems to me if you're concerned about lags, you might wait. But when you look at the inflation report, JOLTS data, payrolls data, and even the ISM data for services, it's all pointing to the Fed going in July.
All right, Dana Peterson, the Conference Board Chief Economist, and also Stephanie Roth, a JP Morgan Private Bank, a Senior Markets Economist. Thanks to you both for breaking down that jobs report. Again, recapping those numbers for you. A lighter than expected report, 209,000 jobs added last month. Unemployment ticking down slightly to 3.6%. Average hourly wages, though, year-over-year basis, rising 4.4%. This is the lightest print that we have seen since December of 2020. Also the first miss for non-farm payrolls in 15 months. 209,000 jobs added to the U.S. economy. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance Live.
It certainly has had some changes, but Netflix, in terms of the FANG, has done extremely well. I would say we may be nearing some kind of a exhaustion, just in terms of how much we're going to see drag in the other areas of the market, particularly if we look at small caps. But FANG will continue to outperform. at least until we get to a point where the interest rates have to rise even further than what anybody expects, if that indeed happens.
Recent survey from Kelly Services finding that although just 28% are seriously thinking of quitting their jobs, almost half of workers say that they are delivering the quote bare minimum at work. So what does this workplace fatigue mean for companies, and how can leaders keep talent motivated? Peter Quigley, CEO of Kelly Services, a global staffing company, joining us now. Peter, we'll get to that survey in a minute, but first I want to get your reaction to the jobs report that we got out this morning. 209,000 jobs added to the U.S. economy, unemployment ticking down 3.6%. Is this consistent with the activity that you're seeing at Kelly Services?
Yeah, I think it is, even though it's a little lighter than perhaps we expected in terms of new jobs. The fact is that the labor market is still tight, and companies, our customers, continue to put an emphasis on both attracting and retaining employees to deliver their work.
Peter, Diane here. Want to ask you, in terms of what you're seeing in your survey data, is that theme of quiet quitting still playing out based on your numbers?
Yeah, so we interviewed more than 1,000 employees in 13 different countries, and the data is pretty clear. Data are pretty clear that there is still a sense of quitting or just doing the bare minimum particularly in workplaces where the employees feel a lack of a sense of belonging, engagement, opportunity to have career opportunities. We also show that the best performing companies are quite the opposite, that their employees are engaged, they feel motivated, they feel a sense of belonging. So it's not all bad news, but companies that aren't focused on employee engagement should take note.
Peter, what are you seeing in terms of average weekly hours worked? We did see that tick slightly high at 34.4 hours per week. But of course, we have seen companies reducing the number of hours that workers need. Are you seeing that from the companies that you work with? And what does that signal just in terms of future job cuts?
Yeah, I think it's been pretty steady, notwithstanding probably some softening. But companies are using a lot of different strategies to deal with this unprecedented labor market in a post-pandemic environment. And so hanging on to workers, but reducing hours is a very common strategy. And they have still scars from the fact that they couldn't find people during the recovery from the pandemic when it was recruiting at all costs. So companies are trying to do a better job. One of the things that we've heard from companies a year ago was, am I paying enough? Now they're asking, am I paying too much? So there's a little bit of a shift in the sentiment among leaders.
Which industries are asking that question, am I paying too much, or is this across the board?
Well, it's pretty much across the board in the industries we support. We're not in healthcare, so I can't speak to that. But companies are very sensitive to being resilient during the downturn whenever, if it ever does happen. I heard Dana's comments about it being potentially honest today. But companies are trying to create some resilience and some flex in their workforce and in their compensation schemes to deal with that.
Peter, when you take a look at the total non-farm payroll employment hitting a new record, 156.2 million. You mentioned labor shortage. How big of an issue is that still here for companies trying to find the workers?
Well, when we survey, our survey suggests that almost half of the CEOs, when they think about their workforce, it's attracting and retaining talent that is their number one priority for the remainder of this year. So notwithstanding some macroeconomic conditions, companies are still very concerned about hanging on and then finding talent. And the number of, whether it's job openings, the unemployment rate, even the relatively or moderating job growth, it still is a tight labor market, and it's not just in any one industry. It's across the board with companies trying to create strategies around how to attract and retain talent. Not just compensation. It's not just a compensation game. It's got to be about creating a inclusive workplace, flexibility. Individuals have choices post-pandemic to find flexible work arrangements. And so that is top of mind for employees as well.
Peter, what's the most successful strategy, do you think, just in terms of what companies have tried, those that are able to retain the workers? What is the emphasis?
Well, I think it's got to be on the complete value proposition for an employee. So it is compensation, but flexibility is a huge benefit if it's possible. It's not going to be possible in all situations, production environments, et cetera, but allowing individuals to not make work the center of their life, but work be an important part of it, but having flexibility, having career opportunities, focusing on upskilling and reskilling so people feel like they have a future. Those are all strategies that the most successful companies that we both survey and work with deploy to deal with this labor market.
Peter, you talked about some of your companies being concerned about attracting and retaining talent. A big part of retention is pay. What are you hearing in terms of willingness to not just, you said there has been concerns about pay. Am I paying too much? But in terms of retention, is there a willingness to increase pay or at least, match?
Yeah, I think the sentiment largely is that you've got to at least maintain competitive wages in order to retain talent. So companies are looking not only at the hourly wages or the salary, but also comp and benefits to see about creating a complete reward package for their employees. So a number of these strategies are beneficial when it comes to retaining, but compensation is always going to be in the top 2 or 3 on the part of an employee in terms of the reward for their commitment to an organization and effort that they put in.
Peter, looking forward here, the sector that's facing the biggest shortage in terms of labor, where we'll see that strength here on out for the second half of the year. What do you think that's going to be? Is it services?
Probably. I would think so. I think it's this environment is, I think, striking because of the variability in where jobs have been created and lost over the course of the last year anyway. But I think services is an area that potentially has some downside.
All right, Peter Quigley, Kelly Services CEO. Thanks so much for joining us. Once again, let's recap the numbers that we just got out this morning. June's employment report, 209,000 jobs added to the economy. Unemployment, 3.6%. Average hourly wages ticking slightly higher here, up 4.4% on a year-over-year basis. This is the first month in 15 months where we have seen a miss on the non-farm payroll number there. It didn't come in above consensus, coming in below what the street was looking for. Street was looking for 230,000, coming in 209,000. Average hourly earnings on a month-over-month basis coming in at up of 0.4%. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
I would say right now they're more in the stagflation environment. That's where they're sort of headed, even if they don't want to admit it, in that they want to see an economy that stagnates while they try to get the inflation under control. But yeah, at this level of yield curve inversion, technically one would think that they cannot avoid a recession at some point.
It's 9 a.m. in New York City. This is Yahoo Finance Live. I'm Shauna Smith along with Diane King Hall. Here's three things you need to know. June's non-farm payrolls report coming in softer than expected at 209,000 jobs added. Well, that's below expectations, but it's still a firm report. The reading reinforcing the narrative of a resilient U.S. economy. The labor market has now added jobs for 30 consecutive months. The data follows yesterday's strong ADP private payroll report, showing that the private sector added 500,000 jobs last month. Market reaction to strong economic data taking a turn yesterday, with investors finally taking it as a sign that the Fed will push ahead with more policy tightening. Bond yields ticked higher, with the benchmark 10-year yield pushing beyond the 4% level. The ripple effect being felt in global equity and debt markets. Fed Chair Jay Powell has not ruled out 2 consecutive hikes this year. Strategists at Bank of America say that investors who piled into tech during the year's rally risk being caught off guard here by higher rates. And shares of Levi taking a tumble after the jeans maker slashed its forecast for the year. It now expects revenue to grow by 1.5% to 2.5% year over year, compared with the previous forecast of 1.5% to 3%. Well, inflation has been a headwind for the company's wholesale business in 2023. Shares are down around 8% year to date. Despite ongoing concerns over excess inventory, CFO Harmeet Singh telling analysts that they are past the peak of the problem. We will speak with him in the next hour.
Well, June's non-farm payrolls report coming in softer than expected at 209,000 jobs added. That's below expectations, still a firm report. Now, stocks facing, though, a reality check in June after a super strong first half. This despite talk of a possible recession and the Federal Reserve signaling more rate hikes this year. But is the market narrative changing? Let's bring in Ben Laidler, eToro Global Market Strategist, to weigh in. Good morning, Ben. Thank you for joining us. Let's start with just in terms of how the market may be just initially reading this print today from payrolls.
Probably a bit of relief. I think we were braced for a much stronger report. We had a very strong services PMI report. We had a very strong ADP private sector report. We know how sort of hawkish the Fed is sort of speaking. So against that backdrop, the fact that this payroll report, didn't beat expectations, on the upside with printing even more jobs than that, I think the market will take with a little bit of relief. But, this is still a mixed blessing. These are pretty strong jobs numbers. These are pretty strong wage growth numbers. It's going to keep us out of recession, but it's also going to keep the Fed on the interest rate hiking front foot.
Ben, why do you think it's pressuring the markets here, at least in the futures? You have all three of the major averages at least on track to open the day lower.
Yeah, I think you scratch the surface. So we've still got unemployment at 3.6%, which is a sort of generational low. We've got wage growth actually picking up to over 4%. So, the Fed still has, more work to do here. And I think the market is, it will probably due a breather. We had this dramatic first half where, even the bulls like we certainly made more money than we thought we were going to make. Third quarter seasonality is, generally tougher. Volatility was too low. And we still have the slowdown to come. We really haven't seen it yet. I'm not calling for a recession, but I think it's inevitable that the economy sort of slows from here. So, I'm pretty bullish, but this is definitely 2 steps forward, 1 step back.
Okay, so speaking of 2 steps forward, 1 step back, and you said you're not calling for a recession. So where does the market go from here?
Yeah, so I think we need to, digest these massive gains that we've made. Basically all the money we've made so far this year has been on valuations. We're going into second quarter earnings season, next week. I think the shoe is shifting to the other foot, so to speak. I think it's going to be much more, we need earnings to start delivering now. And I think we're going to start seeing it in this earnings season. It's a little bit early. This will probably be the trough for overall S&P 500 earnings. They'll be down something like 6 or 7%. But you scratch that surface, and I think the leadership will be tech, which you need to see because we need to validate this big tech rally. But I think you're going to start to see some of the benefits of this tech cost cutting, some of the benefits from AI, spread out from NVIDIA. So I think it's all about earnings from here, and I'd be laser focused on what the tech companies say.
So Ben, you still think that this AI rally that we certainly have seen since the start of the year, it still has some room to run?
I think it's part of the tech story, but it's only one part. So I think, the AI excitement is definitely giving growth back to tech, as is the cost cutting. And valuations, I think, are supported by, the massive derating they saw last year. And investors looking for these sort of defensive growth names. They want to have their cake and eat it. And I think tech sort of offers that. It gives you some of that secular growth, but also you have these fortress balance sheets. You have these, big profit margins. So I think what we're looking for here is, Nvidia was the big surprise last quarter. They were the first to feel the pickup in AI. And I think what we're looking for now is some validation. Is the rest of the tech sector beginning to feel that those tech revenue, those AI sort of driven revenues come their way? And I think that's going to be the story for second quarter earnings.
And then what theme are you looking to play out in terms of second quarter earnings for you?
So I think tech is, the big story. It's led all the gains in the first half. It's by far the biggest, US sector. We had, signs of hope from Nvidia. We now just want to see that validated into the rest of the sector. So I'll be watching that, very, very closely. I think that's by far the biggest story of the quarter. I think commodities are going to be very weak, at least in terms of the reported earnings, really giving back the dramatic growth that they had last year. And, I'd be looking for maybe some weakness out of these sort of cyclical, I call them value trap sectors because, they're pretty cheap, but I think they are exposed to this economic slowdown, which is still coming. So industrials, small caps, over and above the commodity weakness that I think is pretty well telegraphed.
All right, Ben, stick with us here. We want to hear a little bit more about how you suggest investors position their portfolio here in the second half of the year. But first, we got to get to the latest down in D.C. with June's non-farm payrolls report coming in softer than expected at 209,000 jobs added. That's below expectations, but it's still a firm report. Let's head over down to D.C. to get Yahoo Finance senior reporter Jen Schomburger's reaction to this jobs data. Jen, what do you think?
Hey there, Shauna. We're certainly seeing some softening in the job market on the margins with this report. As you've been talking about all morning, that top line payroll number coming in lower than expected at 209,000 versus the 230,000 that was expected. We also saw downward revisions in April and May, 110,000 fewer jobs created than thought. On the flip side, looking back at this June jobs report, we saw the unemployment rate tick down to 3.6%, and wage growth actually tick up to 4.4%. Taken together, job growth for the first 6 months of this year has averaged 278,000 a month. So that's a step down from the nearly 400,000 that we saw every month back in 2022. So the question du jour is, have the Fed's 10 rate hikes finally started to cool the job market? If you take a look at that data, certainly the step down on the top line payroll number to the 200,000 range is welcome. However, looking at wage growth at 4.4%, that is not consistent with 2% inflation. And I think you would hear Fed officials say that while 200,000 is better than what we were seeing in the 300,000 prints, that is still strong by historical standards. And so for these reasons, it is likely to keep the Fed hiking at its policy meeting later this month on July 25th. Certainly the market pricing in a better than 90% chance of a rate hike later this month as well. I think the question from here is the Fed has projected 2 more rate hikes this year. Will they get enough data to continue this trend to see a cooling to allow them to only do 1 more rate hike, or whether they'll still need to do that second rate hike? The data will tell. Guys?
The data certainly will tell, and we know we've heard it from Powell time and time again that the Fed remains data dependent. All right, thanks so much, Jen. We're going to have more on the jobs coverage. Be sure to stick around for Jen's interview with Julie Su, acting U.S. Labor Secretary. That's at 9:45 a.m. Eastern time today. You won't want to miss that. Well, all eyes have been on big tech stocks this year as AI hype sent a few mega caps skyrocketing. We have a next guest here that says that there's some underappreciated category of stocks that could outperform tech. He's going with the acronym of beach stocks. That stands for booking, entertainment, airlines, cruise lines, and hotels. Global travel and tourism is expected to grow by about 23% this year. But with recession fears weighing on the markets, how much of an upside could we see in this sector? We want to bring back in Ben Laidler. He's eToro Global Market Strategist. Ben, it's good to see you here. So I know you were just talking about the opportunity that you do still see in tech, but you're also seeing some reason to buy these travel names. What's the catalyst?
The catalyst is they're still not back to what they were making sort of pre-pandemic. So if you like that sort of reopening trade, I think still has further to go. Secondly, consumers are in pretty good shape. I mean, we've been talking, you talk 4%, over 4% wage growth with inflation, on its way to less than 4%. We're probably going to see in the inflation numbers next week. So consumers are getting a pay rise. We're getting, 200,000, 300,000, more jobs, every month. And the consumers are choosing to spend that money on things that they really care about, like travel. And then on the travel stock side, you're seeing them be very careful at the amount of capacity they add on. They've been very disciplined, which is allowing them to sort of keep pricing. So really, it's the Goldilocks scenario of, more demand and high prices. And, this is one of the few sectors that's managed to actually outperform tech this year.
Ben, let's look at the C in your beach acronym, the cruise liners. So we have seen some pullback in terms of the targets on the cruise liners, and the cruise liners have certainly performed extremely well, whether you're talking about Royal Caribbean, Carnival, Norwegian. How long does this last?
Yeah, so there's definitely some seasonality here. I mean, these types of stocks, unsurprisingly, do well at this time of the year, when we're all talking about holidays, booking our holidays, going on our holidays. But again, I think just zoom back out, that reopening recovery story I still think has further to go. Very few of these sectors are making as much money or are seeing as much demand as they saw back in 2019. So I still think demand has further to recover. And again, you're seeing this sort of double benefit because the holding pricing reasonably firm as well. And, a lot of these sectors aren't particularly expensive either. The pushback against tech is very expensive. A lot of these stocks, earnings are still depressed, but valuations are also, quite low. So I think they have room to run.
Ben, dips like we could potentially see today with futures under pressure. We certainly have seen the market under pressure over the last couple of trading days. Should investors be using those dips as an opportunity to buy? It sounds like it. And is it just that sector in terms of the travel names? You also mentioned tech. Where else are you seeing that opportunity?
Yes, I think the fundamentals justify, buying the dips. But don't just take it from me. I think the other people that are going to be buying the dips here are all the bears. And there's a lot of them, and they're running an awful lot of cash. And I think, the reason that these sell-offs are not going to be particularly big if and when they come is not only, I think, that the fundamentals are still, becoming less bad, but also, these investors that have been completely wrong-footed this year by carrying too much cash will be, I think, stepping up and narrowing those positions. But to answer your question, what should people be buying? I don't think we're out of the woods yet. I mean, inflation is, it's sticky. We still have an economic slowdown to come. So, be invested. I still think the biggest risk is not being in the market, but be reasonably defensive. And I think, these defensive growth names, so healthcare, big tech, these beach stocks, which may not sound defensive, but I actually think they are, given, the demand and supply, dynamic. So I think it's these sort of long duration sectors, things that are going to do well if inflation comes down, if interest rates come down, and the things I'd be steering clear of are these sort of value trap cyclicals, which are very exposed, I think, to the economic slowdown. So small caps, industrials, commodities.
So are you saying that small caps would carry too much risk or too much exposure in the second half of the year?
I think so. I mean, these sectors are very cheap. We know that there's a slowdown coming. They underperformed, they've derated, but I don't see a reason to buy them now ahead of an economic slowdown. I think it's a slowdown. I don't think it's a recession. But I think that's still a better environment for healthcare, for big tech, which, by the way, dominate the stock market. They don't dominate the economy; they dominate the stock market. So this is another, the stock market is not the economy. I think the stock market will probably do better than the economy in the next sort of 6 to 9 months because it's full of these sort of defensive growth sectors, and it is not full of small caps and commodities, which are much bigger in the real economy.
All right, we're walking the tightrope here. Ben Laidler, stay with us. Investors are betting on a weaker consumer. The most shorted stocks on the S&P 500, as highlighted by B of A, are concentrated in the consumer discretionary sector. But headline inflation has fallen recently on supply chains, commodities, and goods prices. Our next guest says that's giving purchasing power back to consumers. We want to bring back in Ben Laidler, eToro Global Market Strategist, for some thoughts on this. So, Ben, where does the consumer stand right now? Is the strength there?
I think the consumer's in good shape. You know, we're printing 300,000 new jobs every month. We have unemployment near record lows. We've now got wage growth running ahead of headline inflation. We still haven't spent down all the pandemic savings. So I think the consumer's in pretty good shape. They are spending, though, on different things. You know, they're spending less on goods, they're spending more on services, they're spending less proportionally online, they're spending more in physical stores. So there's a lot going on under the surface, but I think the consumer is in very good shape. And, you know, these lower inflation numbers are giving the consumer some purchasing power back. You know, with Amazon Prime Day next week. So that's going to be a big data point to sort of see where we are in that, in this trajectory. But, you know, the consumer dominates the U.S. economy. So if the consumer's healthy, the economy is not going into recession.
Even Prime Day will be a good, give us a better sense of how the consumer is holding up. But what about some of the worrisome signs that we have seen in just the last 24 hours? We had Levi reporting a pretty weak quarter, weak guidance that's dominating that stock's move this morning ahead of the open. And then also we had the disappointing numbers from Costco, their June sales coming in below expectations. That isn't a bit of a red flag to you?
The consumer's definitely going to slow from here. I mean, I don't think there's any doubt about that. The question is just how much. And I see it as fairly modest. I think see the consumer as pretty resilient. But also, I think a lot of the things you mentioned are more about what is the consumer choosing to spend their money on. If we don't have enough jeans at this point, having lived through the pandemic and, shop from home for then who knows? We're spending more on services, we're spending less on goods. I mean, goods market, manufacturing is in a recession already. It's services that's really holding the economy up. And so I think the consumer's in good shape, but we're definitely spending it on different things. This again, I think, Prime Day next week, which is obviously focused on online. They sell a lot of consumer electronics, they sell a lot of apparel. These segments that have been reasonably weak so far this year, I think that's what we really need to sort of focus on, and that'll be the sort of health check for the consumer.
Well, Ben, the morning brief today was titled "Investors Waiting for a Consumer Collapse." You don't think there's any sign, at least, or you don't see that likely at all, at least at this stage?
No. Frankly, the bears have been waiting for a recession and a consumer collapse and an earnings collapse for at least a year here, and it hasn't happened, and that's why markets are sort of where they are. I absolutely see a slowdown. I think that's inevitable with rates at 5%, potentially going a little bit higher and potentially staying up there, for a while. But again, I think the consumer is maybe incrementally getting, a little bit stronger in some ways right now, with wages rising above inflation and unemployment still at record lows. So that's definitely going to ease. The consumer will pull back a little bit, but I think those looking for a sort of consumer Armageddon here are going to continue to be very disappointed.
Well, Americans like their shopping. Prime Day, we know, you mentioned obviously, but we also know it's next week. So what are you looking for from shoppers? I mean, last year were very solid numbers, and I know this year they're also doing some kind of invite only, I guess, to stoke demand. What are you expecting from Prime Day this year?
So this is basically the biggest shopping day of the year, or one of the top three. I think we're looking for something like 13 billion of sales. When you add in, about half of that, or a little over half of that, is Amazon, and the rest is, the sort of Targets and Walmarts of the world that are going to sort of piggyback on the back of that. Those will be very solid numbers. I think they'll be up on last year. And again, I think we're going to be, looking through the weeds a little bit just to see where is that relative demand. As I say, online, apparel, consumer electronics, been under a little bit of pressure as the consumer's been sort of focused more on, beach, going on holiday or using services and things like that. So I think it's going to be pretty solid, but I'll be looking at some of those underlying trends as well.
All right, Ben Laidler, eToro Global Market Strategist. Thanks so much for joining us here this morning. Well, Mark Zuckerberg's new app, Threads, has surged past 30 million users as it takes on Elon Musk's Twitter in a battle of social media giants. Now, Threads, which requires an Instagram account, allows users to share up to 500 characters of text and videos of up to 5 minutes in length with no limit on how many posts can be seen. When you take a look at these numbers, Diane, at least over the last 36 hours ago, a very strong showing in terms of the interest that we are seeing in Threads. But I think the question that everyone is asking, a lot of analysts are asking about what this exactly means to Meta's bottom line, if this really is going to move the needle, and if some of the traction that we have seen over the last 36 hours or so, if that's going to last.
Up. Exactly. I mean, it's, you know, it remains to be seen if this will be a blip or not. I mean, Zuckerberg is clearly going all in on a new social media channel, and you see Elon Musk certainly seeing it as a threat with the, you know, response of threatening a lawsuit because, you know, it's very similar to Twitter in terms of how it looks. I think it looks a little bit different personally, and I'm one of the 30 million who signed up for it. And you know, I do like it. It's got a clean look, so I like that aspect of it. You know, there's something about the font that to me is a little bit different than Twitter. You can't DM yet, so you have to, everything's public. If you want to reach out to somebody, you're blasting it out to everybody right now. So it does remain to be seen how they'll monetize it, you know, especially like we know that Meta was already facing the challenge of how they do Reels with regard to ads within Reels. So we talked to an analyst yesterday who said, obviously, this seems like it would be an easier place to position advertising, you know, every so often you see an ad, I don't know, every 7 posts, something like that. So there's certainly the place for that there. So it's probably an easier platform to monetize compared to, say, Instagram Reels.
Yeah, and I think that's the question here going forward, especially for analysts, just in terms of the fact that this could be a very attractive platform to advertisers, given the amount of data that Meta already has access to. They know so much about consumers' buying behavior, what they like, what they don't like because of their other platforms, because of their other apps. So that, of course, will give them some advantage or significant advantage, you could say, over some of the competitors out there. I think also we have seen some glitches. So this launch hasn't gone off without a hitch. There was some reports and some people that were tweeting actually that they were having some problem posting on Threads over the last 24 hours. But also there was actually a problem if you delete Threads, it could delete your Instagram account too. So Meta is saying they're trying to look into that, right?
Yes, because you can't just delete Threads. I mean, delete your account, right? You're deleting, I guess, the whole thing. So, you know, I'm sure they'll figure that piece out. Did you sign up yet or no?
So I did. I haven't posted anything on it, but I needed to check it out.
Is it a thread or a post? Are we threading?
I was going to say, I guess you're technically, well, you're posting, you're threading, you're just not tweeting.
Yes,
there,
you're
that's
not.
safe to say.
No, exactly. All right. We'll put a pin in that, a thread in that. I don't know what we're doing. All right, all your market action ahead. Stay tuned. You are watching Yahoo Finance.
I would say that AI will continue to be the contender. It's already obviously proven itself, and I don't see any reason why that will go away. We have a tremendous amount of competition now happening among some of these tech giants, like Meta's announcement of Threads, for example, trying to hone in on the Twitter space, Apple that took some of the thunder away from Meta with VR. And I think those are the stories that we'll continue to see.
We are keeping an eye on impact to retail this morning. Shares of Levi are falling under pressure, down 7% in the pre-market after releasing its quarterly report card after the close on Thursday. The well-known jeans maker cut its revenue growth forecast to between 1.5% to 2.5% from its previously forecasted 3%. The company also lowered its earnings per share, expecting it to be between $1.10 to $1.20 from its earlier prediction between $1.30 to $1.40. As we know, it reported a loss of $1.6 million. So certainly showing some weakness with regard to the consumer. And I mean, we've heard that play out in terms of where the consumer is in its spending on experiences versus goods. And the company also talking about planning some price reductions as well, Shauna.
Yeah, exactly. We heard it from Ben Laidler earlier in the hour saying that people simply are not spending on jeans or using their money elsewhere. We have certainly seen that trend where consumers are favoring experiences over some of the retail buying activity that we certainly did see take place during the pandemic. I think promotional activity, the expectation there for increased promotional activity in the short term because of these disappointing results is one of the big reasons why we are seeing some of that pressure on the stock today, given the cut from on guidance that we heard from Levi's yesterday. Pressure in the U.S. wholesale business, certainly something that has been weighing on the company, weighing on its results for the last several months. Macro pressures there are partly to blame. We mentioned the fact that inflation is still very persistent, still very sticky. People are spending more money in almost every other aspect of their lives, are being forced to reduce their budgets, to cut their spending on certain items. And we certainly are seeing that reflected across the consumer discretionary sector. Many of Levi's competitors out there have seen these types of trends over the last couple of months.
Yeah, and like you mentioned, Ben, speaking earlier about just consumer trends in general, and like the trend to spend on experiences versus goods, like, you don't need the jeans so much now. People are back in office more, so they're buying the blazers and, slacks, I guess. So that's, certainly you're seeing that just shift away from the more of the leisure type of activity, and even a well-known brand like Levi would suffer as a result. And, so they're expecting to see price cuts, promotional pricing on things like its 502, 5112 jeans. I don't even know, I haven't bought a pair of Levi's in I don't know how long. So I was surprised that I shouldn't say any demand, because people love them. We know Sazi loves them.
People do love them, but I also think it's a sign of the times what we're seeing in terms of investor behavior as well. Bank of America was out with a recent note here saying that the list of the most shorted S&P stocks are dominated by consumer discretionary names. Lots of expectations out there that this group is going to underperform, at least in the short term. And speaking of the short term, Wells Fargo also weighing in on these results here from Levi's, calling it a very tough quarter here for the company, and they expect those headwinds, those challenges to persist here, at least in the short term, saying that this near-term setup here for Levi's looks challenging. We're seeing that reflected in the stock action today, with the stock off just about 8% here ahead of the opening bell as we count down the final seconds here until we do kick off the final trading day of the
shortened week, right? And stay tuned later this hour when we have the Levi's CFO Harmit Singh talking with our own very own Rochelle Okufo. And let's get right to the opening bell action on Wall Street. You're seeing a little bit of pressure in the early action, with stocks kind of showing some softness as investors try to read the tea leaves on the latest jobs number, but also just continuing the trend from the week. We've seen a downdraft in this holiday shortened week, so all three major indexes under pressure this morning, although the Nasdaq really a little bit flat at the moment. Let's get right over to Shauna at the Wi-Fi Interactive for a deeper dive into what we're seeing this morning.
Yeah, Diane, we're seeing some pressure here across the board. We mentioned the fact that the jobs print did come in below expectations, but it was still above 200,000. So overall, this could be categorized here, and it is by the street, as a pretty strong print. And that's why we're seeing pressure here across the board when it comes to the major averages. The Dow opening off just around 100 points, just over 100 points. We've seen some selling pressure over the last several days, over the last 4 trading days, really losses of nearly 2% today. The Nasdaq also opening off just about 0.1%. We're also seeing some of that pressure throughout the S&P as well. Taking a look at the sector action and some of the pressure that we are seeing in some of those larger names, we know the tech trade was certainly a massive winner in the first half of the year. We're seeing a bit of a rotation out of those names. Some questions just about valuation. That's reflected in the early action, at least for now. We have Apple, Microsoft, Google among the names in the red today. Amazon and Nvidia, though, two winners from the first half of the year, are at least opening the day higher. Taking a look at some of the leaderships or some of the momentum that we're seeing in other parts of the market, I want to take a look at some of those semi names. I mentioned the fact that Nvidia opening the day higher, but certainly a mixed picture here when you take into account some of the losses that we're seeing elsewhere. When you take a look at Broadcom, when you take a look at Applied Materials, some pressure there. Bank stocks, a very important sector here to obviously watch. We'll start hearing from the banks next week when they report their earnings. JP Morgan opening up just about 1%. Bank of America also in the green. Wells Fargo and Morgan Stanley certainly still a mix there. We can take a look at some of those other names that is very important to keep an eye on here. Travel, one of the investment opportunities that we heard from Ben Laidler earlier on in the program, saying that as we see the shift in how consumers are spending, that spending pattern, focusing on experiences, focusing on travel, he's seeing an opportunity in some of those travel names that, at least for today, we are seeing some green on the screen, led by Carnival. That stock up just about 1%. But bringing it back to those major averages, all three of the major averages opening the day under pressure. We had the Nasdaq right around the flat line. Also, the action in the bond market is going to be very important to keep a close eye on. We know the 10-year yield breaking above 4% earlier in the trading week, hovering just above 4%, still up just about 3 basis points. So some of that activity in the bond market certainly driving the equity action today.
All right, Shauna, there we go. We're also keeping an eye on Biogen and ASI. Those stocks moving under some pressure. ASI down 4%, Biogen down nearly 1.5% on news. That the FDA officially approved the first Alzheimer's treatment. Yahoo Finance's Anjali Kamlani is joining us now with more on this. Anj?
That's right, you guys. So good news, of course, for ASI and Biogen finally getting across the finish line and getting that Medicare coverage, really key for the company here with this approval. Let's recap what's going on, though. The company getting the FDA full approval, Medicare announcing coverage, but with one caveat. Of course, we knew this was coming. They are looking for potential concerning side effects. So the label does include a warning to look for abnormal MRI brain scans and monitor those who are at higher risk, including testing ahead of time. Those are at higher risk age-wise for Alzheimer's. So that's something that is going to be a massive effort and burden on physicians and clinicians alike, as well as on patients. There's also a registry that has been launched to continue monitoring all of this. Now, meanwhile, we also know that analysts have said that they don't believe that these label changes, will impact really. It is, like I said, something that was expected, but the uptake is going to possibly be slow in 2023 as the ramp up comes, and then acceleration in 2024. Meanwhile, CMS, of course, celebrating this, saying that this will be covered broadly. Welcome news for the millions of people who will be impacted and their families. And of course, we know this really affects millions of people. So good news right there.
Indeed, good news for them, although the market's not reacting that way.
No.
It's often counter to, what the people who would respond to it as good would see it as. All right, Anj, thank you so much. We appreciate that. All right, let's take a look at Alibaba. Now, China authorities have hit affiliate Ant Group with a $985 million fine. Shares of the company have been tracking higher this morning, up over 4% on expectations that authorities would levy the fine and finally wrap up a long-standing probe of the e-commerce giant's fintech arm. Now, regulators forced Ant Group to cancel its blockbuster IPO and to restructure its business in 2020. Again, we're seeing a positive reaction in terms of Alibaba and that putting that issue to bed, Shauna.
Yeah, and I think also just more broadly what this signals for the sector over there when you take into account so many of these Chinese tech names had been under pressure given the crackdown that we had seen from regulators. So this fine, what it paves the way for just in terms of the potential for future growth, restructuring plans for an eventual IPO. That, of course, is seen as good news here among investors. One of the reasons why we're seeing a pop here in shares this morning. It's being reflected across the board on some of its competitors as well. JD.com also opening the day up just about 2%. Some U.S. e-commerce companies also in the green here, but allowing the fintech giant here to resume that business growth, bringing back some of that hope that Beijing is going to finally ease some of those regulations, some of the crackdown that we have seen on the tech sector. That's what's really driving the early reaction.
Yeah, on the tech sector, and also just kind of that crackdown on Jack Ma's businesses, basically. Alibaba and Ant Group were both his babies.
Yeah, certainly.
So.
Yeah, Alibaba shares up just about 4% today. All right, well, June's non-farm payrolls coming in softer than expected. The U.S. adding 209,000 jobs last month. While it's below expectations, the reading reinforcing the narrative of a resilient U.S. economy. But can the latest jobs data move the needle for the Fed? We want to bring in Paul Grunwald. He is S&P Global Economist here to discuss more on this. Paul, coming in weaker than expected, still above 200,000, enough to guarantee that the Fed's going to keep hiking?
Yeah, I think so. I mean, it's a little bit lower than expected, and I guess for the first time in 15 months, we got a lower than expected number, but it's still over 200,000. The unemployment rate is 3.6. Wage growth ticked up. So if you put all that together, it's a mixed report at best, but I don't see how this changes the expectation that the Fed goes 25 basis points later this month.
Did it surprise you, the number coming into this? I mean, I know that expectations had ratcheted up a little bit given the ADP numbers yesterday, but did the number surprise you at least a little bit?
Yeah, a little bit, especially, right. ADP yesterday was what, 489? It was a huge number, so I think everyone was expecting the report this morning to come in a little bit hotter. Again, I mean, it's moderately good news, but I think it's not big enough to move the needle. And it's really the wage growth too, right? If we're thinking about monetary policy, big debate amongst economists, what's the unemployment rate that's consistent with 2% inflation? Does it have a 3 handle or a 4 handle? I think it almost certainly has a 4 handle. So we need to get that unemployment rate gradually up, but the wage growth is going to be a challenge for the Fed.
So what does that mean just in terms of how high rates are going to be, that higher for longer narrative that we're starting to hear more and more about? And beyond that rate hike possibly later this month, what do you think is the potential here for a second rate hike?
Right, so we're in the higher for longer camp. We just put out our credit conditions reports last week. So I think a couple of things have happened. One, this cycle, the Fed's been kind of leading the market, right? In previous cycles, we had the Greenspan put, the Powell put, the whatever Fed put. This time, the Fed's kind of dragging the market closer. But what we've seen is if you look at the end year expectations for where the market thinks the Fed's going to be, they're now in the low to mid 5. So the Fed's kind of convinced the markets that they're going to raise rates and stay there. Whether it's 1 more or 2 more, we really need to start seeing some more cracks in the data. So if you look at unemployment, we've been 3.6, 3.7 all year. PCE core inflation, which is what the Fed watches, that's been stuck at 4.6, 4.7. So we're just not moving on the numbers that need to move.
So does another hike then position the unemployment number to hit that 4 handle that you're expecting?
Yeah, it's a question of how it hits the 4 handle, right? The sort of higher for longer view is that we don't have a recession, but we kind of, slowly ratchet growth down. If the unemployment rate drifts into the low to mid 4s over the next couple of quarters, that's going to be a win. Inflation sort of drifts down into the 2s. That's the soft landing scenario. But again, we're not seeing much action on those numbers that need to move. We all know monetary policy moves with a lag. But I think 1 more is definitely baked in for the Fed. And do they keep going after that? I mean, the Fed said 2 in the latest statement. So we're in the kind of 1+ camp right now.
What do you think of that wages number? You mentioned the fact that did come in above expectations. Clearly a very important data point for the Fed.
Right.
I guess, how is the Fed looking at the fact that inflation or wages consistently are so persistent to the upside here, and what that really tells us just about how long this fight to get inflation under control, what that timeline potentially looks like?
Yeah, I mean, the timeline's a big question, right? Yeah. So if we think about the golden path for the economy, inflation's 2, we've got full employment, growth is maybe in the high 1s, just below 2. We want to get onto that path, right? We're above the path now. We know that because inflation's too high and unemployment's too low. If we get onto that path abruptly, that's the recession scenario, right? We get some negative or sharp downturn in growth. So they're trying to guide it onto that path over many, many quarters. So there's a lot of tailwinds, right? You guys have been talking about it on the show. So that suggests we might be able to, land it a bit more softly than some people think.
That 2% target, though, from the Fed talk, and we heard some Fed officials weighing in on the fact, but there's been discussions about maybe we should raise it. Maybe it should be more in terms of 3%. Does that make any sort of sense to you?
I'm in the hardcore camp on this one. And I think, first of all, traditional is, right, the old guy thing. But, if you say low and stable prices, that means people don't think about inflation on a day-to-day basis. It's not really part of the wage setting formulation. So that's been codified at about 2. I agree that it's more difficult to get inflation down from, let's say, 3 to 2 than 5 to 3. But if you think dynamically, that's not going to work, right? Because if you say this time, well, let's throw in the towel and settle for 3. The next time we get an inflation burst, it's going to be hard to get it down to 3. Maybe we'll throw in the towel and get it only down to 4. So we have this kind of, we have fancy terms for everything in economics, dynamic inconsistency, right? So we ratchet higher. I think it's worth the effort to get inflation back down to 2 because I think that's kind of better for everyone over the longer term.
So speaking of worth the effort, then how many basis points are you expecting in this month? Are we looking for a 25 basis point hike?
Yeah, I think we're done. I mean, hopefully we're done with the 50s and 75s, or even Canada had 100. But I think we're in the 25 zone. But again, there's a big question mark about how much of the tightening needs to still filter through. If you look at real interest rates, they're not that high. If you look at financial conditions, they're not that tight. So there's this sort of pointing to the fact that we need to do more. But again, all these hikes over the last, 5 quarters have to work their way through. The good scenario is we let the air out of the balloon softly, we get away with 1 or 2 more, but I don't think that's a done deal yet. We got to wait for some more data on the labor market.
You still think there's odds of a soft landing, right?
I think that's probably, unless the bottom really falls, the hard landing scenario is one where the bottom falls out of the labor market, and today shows that that's probably not in the cards in the near term.
Yeah, labor market extremely resilient. Yep. All right, well, Paul Grunwald, S&P Global Ratings Global Chief Economist, thanks so much.
Thanks very much.
We will continue with all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
I think it's going to be extremely mixed because the companies that actually have been able to maintain an operating cash flow in this current environment will do well. Those that their expenditures may have actually exceeded their actual cash flow won't. And we don't really know exactly. We can guess that some of the tech companies, obviously, that have done well will continue to do well. Particularly, they have the room for stock buybacks, paying dividends. But I think it's going to be a very mixed earnings season.
Welcome back. The job market remains the focus this morning. The Labor Department reporting that employers added 209,000 jobs in June. That was a surprise, weaker than expected. Unemployment rate came in at 3.6%, in line with expectations. In terms of where the job market has come, it was softer than expected, but still holding above that 200,000 level, still marking a sharp drop from May, when we saw May's number revised down to 306,000, but still a sharp drop when you consider it in perspective. Investors trying to read the tea leaves on what this means for what the Fed's next move will be, right, Shauna? The expectation increasing for another rate hike, and that still remains the expectation heading into the Fed's next meeting.
Yeah, and I think that's clear really from the market's reaction, at least initially, to this report. The fact that we are seeing some slowdown in the jobs market did come in below expectations, added 209,000 jobs last month, still above 200,000. Unemployment rate, 3.6%. I don't think that this really changes anything for the Fed. We was taking a look at a couple of notes out this morning. Chris Rupke, one of those notes saying that the less than expected jobs data won't scuttle the Fed's plans for a rate hike on July 26th. You can bet on that. I also want to point out one thing that we haven't talked about much yet, and it goes along with that slowdown theme, but the number of people with part-time jobs, that increased by 452,000 to 4.2 million in June. Some of that increase being attributed to the fact that employers are cutting down hours worked here for their employees, but it does fall in line with that slowdown theme, some of the easing that we have seen in the jobs market, but still overall a way too hot report here, at least in terms of how the Fed is looking at this. Rochelle Akufo has also been digging into this report, joining us now in the conversation here from DC. And Rochelle, when you take a look at the market's reaction, we had the Dow and the S&P still in the red. The Nasdaq's actually holding on to gains, but I don't think it's changed the Fed's narrative or likely to change the Fed's narrative at all. What do you think?
I mean, I don't think so either. I mean, we know that the ADP numbers sort of set us up for the okie doke today in terms of expectations here. I mean, but you're still looking at unemployment below 4% for the longest streak on record. So look, the Fed is saying, we've been saying that we have more work to do. Clearly, the economy can take what we're doing. So even with this pause in mind and sort of letting the Fed's medicine work through the system, the Fed can still push ahead, which is why we're seeing these mixed markets. Obviously, when it comes to the Nasdaq, tech still sort of lifting all boats at the moment, whether or not they should be or not, depending on when you're looking at valuations. But also looking at annual pay rising at 6.4% in the US. So you have this pressure, then you have a lot of employees saying, look, you're going to have to pay us to retain us. You have this historically low unemployment rate. So it's putting some of these companies in a very difficult position in terms of factoring in additional labor costs while they're trying to grow and they're trying to sort of pour into this bull market. So it's a bit of a precarious situation.
It is. It's a tightrope. I mean, we talked to one of our experts earlier from Kelly Services about the dance that employers are having to do, because employees are still saying, show me the money. Employers are saying, how much, and then I just want to take this back to the Fed expectations really quickly as well. Looking at the CME Fed Watch tool, the expectations now basically over 90%, nearly 95% expecting a hike at this next meeting in July, despite these numbers, and especially when you consider that it's still above 200,000 in terms of how Wall Street reading it. It's still a mixed reaction in terms of markets, but as we've heard from expert after expert, the market is not the economy.
Yeah, the market is not the economy, not enough to put the Fed at ease here. In terms of where we did see the hiring, it was really concentrated in just a few sectors, led by gains in government, in healthcare, and in construction. Payroll is actually falling in retail, transportation, and warehousing. That's where we saw some of the drop here in the most recent months. But I think the conversation, it always comes back to wages, and that we know is so critical here for the Fed. It's a key component for the Fed. Wages increasing faster than expected, at a faster than expected pace in June, at 4.4% on a year-over-year basis, obviously lending to the narrative out there that the Fed is going to remain hawkish, remain aggressive in their fight to get what has been very, very sticky inflation here, Rochelle, under control.
All right.
It's true. I mean, but even when
Sorry, go ahead, Rochelle.
I was just going to quickly say, when we pair that with some of the disagreements that we saw in the FOMC minutes about whether or not they should pause, it does mean that it's not a super certain road ahead. Clearly, there was some dissent in the ranks, so the final decision was unanimous. But when you have a data-dependent Fed who's sort of taking it ear by ear, still looking at those potentially 2 rate hikes, because as I said, the economy can clearly take it right now.
Oh, the next one's likely happening. All right, we're going to put a pin in this conversation for now. More of your market action ahead. Stay tuned. You are watching Yahoo Finance.
I don't think we're paying enough attention to the absolute social unrest that we're seeing in pockets throughout the world globally. Part of which is because of deglobalization. Part of it, of course, is because of inflation and higher interest rates. So I think we have to keep an eye on how far people can be pushed in rising interest rate environment, while at the same time also rising inflation, particularly with food and energy.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. Well, with the Labor Department report coming in a bit softer than expected on that top line payroll number, 209,000 versus the 230,000 expected. But on the flip side, the unemployment rate ticking down to 3.6% and wage growth coming in stronger than expected at 4.4%. For more analysis on this, I want to bring in Acting Labor Secretary Julie Su. Secretary Su, thank you so much for joining me. It's great to be with you at the Labor Department.
Thank you, Jennifer. Good to be with you.
So we did see a little bit of softening softening on that top line payroll number, 209,000, and we saw some revisions downward for April and May. So we're in the 200,000 range, a bit softer than the 300 print we had been seeing historically. Do you think that the Fed's 10 interest rate hikes are finally starting to cool the job market?
Well, so this is a good jobs report. This jobs report represents steady and stable growth, which is what we want in the economy, right? That is part of President Biden's economic plan, is to make sure that there is steady growth. He's helped shepherd a recovery from the pandemic-induced recession, and now we see continued growth. And combine that with the 3.6% unemployment rate, which, for the last 17 months straight, unemployment has been less than 4%. It hasn't been like that since the 1960s. And so those combined figures really demonstrate that President Biden's economic policies are working, and what we do want is that steady, stable growth as represented by today's report.
To your point, as far as strength is concerned, we saw wage growth of 4.4%, still very strong, still seeing a lot of demand for workers in this economy, especially in the services sector. How much of that strength do you think is being driven by lingering effects from the pandemic? Lower immigration, early retirements. How long do you think that's going to persist?
That's right. So we are in a tight labor market, right? In a tight labor market, workers have more power. They have more choice. They have the ability to move from jobs to better jobs. And we've certainly seen that since the president came into office. But we've also seen a return to pre-pandemic labor force participation rates, especially in that prime age workforce from 25 to 54. And that is also a sign of a strong economy, of people having confidence, of people coming into labor market looking for jobs and getting jobs. And those are all good things, and we certainly see that overall. But for women, we see that women have now marked the third straight month of the highest labor force participation rate for that age group in 75 years. These are all signs of strength. It's a sign of Bidenomics having the effect that we had, and all these things really, frankly, defy expectations.
How much longer do you think that workers are going to keep the upper hand here, and we're going to see these trends persist before the Fed finally starts to cool the job market?
Right, so I don't want to speak to Fed policy, right? But certainly what we are really committed to here at the Department of Labor and across the Biden-Harris administration is making sure that additional investments are creating good jobs in every community, and also bringing industry to the U.S., right? We're focused on manufacturing. We've had almost 800,000 manufacturing jobs created since the president came into office, and we're just getting started. We have infrastructure investments. We have semiconductor and chips. So all of these things are about delivering things for the American people, and also creating good jobs in every community. And again, today's report is a sign that that kind of stable growth is not only possible, but it is actually happening under President Biden.
You mentioned women's participation in the labor force at a record high, above 77%. Yet women's wages, if you look at women versus men, they're only earning 83 cents on the dollar versus men. And we're talking about women in full-time jobs here. Why is that gap still persisting, and what can be done to really close that?
Yeah, thank you for mentioning that, Jennifer, because we talk about women helping to power this recovery, right? And women, as always, are doing our part. But there remain systemic issues that affect women. Obviously, some of it is care and the cost of care, something the president's talked about a lot. There's also occupational segregation that leads to the gender wage gap. And we see this moment, and the president has been crystal clear about his commitment to equity, leave no one behind, make sure every community comes along in the growth that we have. And so part of it is the jobs that we're creating. We want to make sure that women have access to those jobs, that they have the training that they need to participate in manufacturing, in construction, right, in all of the growth that's happening. And so those are priorities that we have. When the president says we need to finish the job, we have more work to do, that is part of what he means.
Is the president, is the administration looking to put in place any further policies to maybe help with childcare or help women who want to participate in the workforce or participate in jobs that would allow them to aspire for higher paying positions?
Absolutely. So the president has called for policies, right, like paid leave. He's indicated the importance of care work and making care both affordable and care jobs, good jobs, because most of those jobs are also done by women. One of the things we're focused on at the Department of Labor is creating workforce development programs where we bring in workers and employers to focus on how we create opportunities for women. And what we've seen is when we do that, women step up, right? Women do these jobs, and it helps to close that gap.
Switching gears, Secretary, UPS drivers are potentially on the verge of a strike. Teamsters, the labor union that represents more than half of UPS workers, some 340,000 workers, has come to an impasse with the company. Are you prepared to intervene? Are you talking with parties at all? And if there were to be a strike, what kind of impact would we see on the job market and the economy, just given how integral UPS is to supply chains and companies that are relying on that company to get customers their products and packages?
Right. That's such a good point about, the importance of the work that UPS workers have done and the importance of what that company, throughout the pandemic, right? There was increased demand for package delivery, and UPS workers stepped up to do that. I believe, as the president believes, that the collective bargaining process works, that parties coming together at the table and bargaining for wages and working conditions and benefits and the like, that is a process that we should respect. That's a process that has historically delivered not only gains for the people at the table, but to create the middle class, right? Unions made the middle class. That's something the president says all the time. And so I have faith that the parties are going to find a path and continue to try to work things out, and that there are win-win solutions, as we found when I went to the ports to help.
But you're standing back at this point. You're not intervening.
Right. We believe in the collective bargaining process, and we believe that the parties need to be given room to do what they know how to do best.
And before I let you go, Secretary, sticking with the union trend, the UAW, their collective bargaining agreement is set to expire with the Detroit 3 automakers in mid-September. President Biden has appointed a advisor, Gene Sperling. I know he's working very closely with you. How are talks going? Are you prepared to intervene to stop any striking if it were to occur?
So I am working very closely with the White House. This White House has been this administration has been very collaborative around a whole host of issues. I think that's a premature question, right? I think the broader issue, which is consistent with Jobs Day, is that jobs are growing, workers have come back to the labor market, and bargaining is taking place because in a tight labor market, workers have more power, and that's all a good thing, because that's how we create an economy from the bottom up and the middle out, right? That's how we make sure that every job is a good job. That's how we make sure that we honor what workers have done and their power in the workplace. I think those are all part of the Bidenomics vision of what makes a good, strong economy.
Secretary Sue, thank you so much for your insight. It was great to have you on the program.
Thank you so much.
Speak with you again soon.
Thank you. Me too.
And we will be right back.
No, I have not. But I do know everybody else has, so I feel a little bit left out.
Same here. I can only say that I've picked up one of the. Do you call them paddles? Are they rackets? Is it a packet? What is it? I don't know yet. We're gonna kind of put that one to the committee here.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Rochelle Akufo. We're about 30 minutes into the trading day. Let's check in on the action here. The S&P 500 at least tipping into positive territory Friday morning after a rough start. Stocks are reacting to this morning's jobs report, coming in short of expectations with 209,000 jobs added versus the 230,000 that was expected. Unemployment ticked down slightly to 3.6%. Hourly wages are ticking up to 4.4%. Let's take a look at some of the top movers of the day as well. Kicking things off, I'm watching shares of Rivian. The EV maker jumping today after Wedbush gives the company a bright outlook, raising the price target on the stock to $30 from $25. Analyst Dan Ives saying he sees light at the end of the tunnel for the automaker, citing further confidence in Rivian to hit or exceed its delivery targets heading into the second half of 2023 and 2024. I'm also watching shares of Paramount Global. The entertainment company sliding today after a downgrade from Wolf Research. The analyst cutting the company down to underperform from peer perform, saying they expect upfront to fall short. And lastly, I'm looking at DigitalOcean shares in the company. Those popped after they announced a $111 million acquisition of cloud infrastructure company Paperspace. So as you can see, they're still in positive territory there. Well, despite the Fed's best efforts, the labor market remains tight. As jobs data came in below expectations, the US still added more than 200,000 jobs in June, as sectors like leisure and hospitality maintain high demand for workers. So how can employers meet the demands of staff in these high churn jobs? Joining us now is Rachel Romer, Guild CEO and founder. Good to have you on the show, Rachel. So I want to get your reaction to these numbers because you work with a lot of big brands, including Walmart, Target, Chipotle, Hilton. When they see this data, and especially that wage growth, what's the reaction there?
I think that wage growth shows that employees continue to have a lot of influence in this market. You know, the headlines can often cover right now what everyone's concerned about from the Fed and interest rates. But when you zoom out a bit, we are still at a 60-year low in terms of our unemployment rate at the 3.6. And so employees still have a lot of influence in this labor market. And that means employers need to listen to what those employees are asking for.
So then when you look at the most in-demand skills at the moment, what are they and sort of what industries are they spread between?
You know, I think it's a confusing time for employers when they're thinking about skills. I think at the upper echelons of most corporate headquarters, there's a lot of conversation about AI and the technology skills needed to deliver those. But then in the day-to-day work, everyone is still required to do the jobs that might eventually be touched by AI. What that ultimately means is that the only skill that is future-proof is the skill of learning. And that's a complicated one and one that employers haven't spent a lot of time investing in. And so we find that the most innovative companies and their executive teams are turning their attention to thinking about building cultures of learning and cultures of opportunity.
And so then in terms of the pipeline of skills growth and trying to match the skills to what employees actually want to do, how much of a mismatch is there between the C-suite and what workers are actually looking for?
Yeah, that's a great question. I think that the AI movement is going to only broaden that because what we know is that the top thing that the frontline American workforce, the 100 million group, the 2/3 of our workers in the US, what they're looking for is career mobility. And so they want to gain the skills and capabilities that give them a chance to move up in their companies. I think the most innovative companies like Target, like Walmart, like Chipotle, like Hilton are really thinking about how do we give our employees pathways upward in the company and meet that career mobility demand. But we also know that AI is risking really hollowing out a lot of those classic middle-class jobs. And so it's going to be imperative that companies find ways to give their employees a clear sense of the pathway upward in the company.
And obviously, when we talk about AI and how much of a game changer it's continuing to be, what sort of skills are some of these employers offering? And what are sort of the costs that come with that on top of wage costs?
So fortunately, educating your workforce is a fractional investment relative to wage costs. Well under 3% of total wages go to the learning and investment. So we we know that any company who wants to invest in learning can easily make that investment. The hard part is picking what are the right skills and competencies that build towards the future workforce planning. And I think that's where a lot of CHROs are scratching their heads right now. As mentioned, we know that the foundational ability to learn is the most future-proof skill. What you can then stack on top of that is the ability to learn any new language, any new skill set. And you look back a year ago, who would have known that prompting ChatGPT was going to be a new in-demand skill? And what we know is that a year from now, there's going to be another new novel skill that we can't even contemplate right now. So teaching your workforce to be a nimble learner and to be a nimble consumer of new technologies and new content is ultimately the most important skill set.
And I do want to ask about the Great Resignation, because we essentially thought that was going to be over as conditions got a bit tighter. People started tightening the purse strings. It's still ongoing, though. How is that affecting sort of the talent pipeline and this sort of rush to try and get some of this talent to match the skills available?
Our view at Guild is that we do still see a decent amount of resignation from traditional W-2 workforce into the gig economy. I think that part got a bit missed in today's headlines. And so I think it's incumbent on larger businesses, those that have W-2 workforces, to think about their competitive advantage vis-a-vis the freedom or flexibility that comes with gig economy. And so large companies are really thinking about what can we provide in terms of benefits that are differentiated? What can we provide in terms of security that is more stable than gig economy? And then what can we provide in terms of pathways? What can we show the employee about how they can grow and develop, whereas gig economy doesn't have those three value propositions? So I think the data today shows that companies that want to have a strong W-2 workforce need to continue investing in those core security, pathway-oriented jobs.
And it does seem that the power still remains with the employee at the moment, but you're also going to have student debt repayments kicking in. That's going to be taking another bite into people's finances there. How do you see what Guild can do and what some of these companies should be looking at, given that perhaps some of those dynamics might start shifting?
I'm glad you asked. We think a tsunami wave is headed towards the U.S. economy as those loan payments kick in that have been on pause for 3+ years at this point. I think it'll do two things. One, I think we will see folks picking up more hours, spending more time or seeking overtime shifts, and returning to more stable workforces. I think the employers that want to win the war for talent will also think about how to help solve that student debt challenge for their workforce. That's part of why Guild is partnering with Candidly, a student loan reimbursement and optimization company and platform that can help companies across the board provide loan repackaging and loan repayment solutions for their workforce. And I think you'll see those type of solutions surge for companies that want to both attract the best talent and help that talent solve this looming crisis that I think is headed towards us this fall.
And as you said, a tsunami to keep an eye on there. A big thank you there to Rachel Roma, Guild CEO and founder. Thank you for joining us this morning.
Thanks for having me.
You're very welcome. Well, jobs in construction grew once again in June, adding more than 20,000 jobs to the sector. Let's get the breakdown with Yahoo Finance's Danny Romero. Hey, Danny.
Hi there, Rochelle. Well, hiring in construction isn't slowing down. So let's take a look at these numbers. The number of construction jobs that were added were 23,000 in June. And then let's go into a deeper dive into what this actually means. So for building and construction, so this is for commercial and residential building. It grew there. Heavy and civil engineering construction is more on the infrastructure jobs. So think of civil engineering. So that also grew this month. And then the specialty trade contractors, think of painters, electricians, those that remodel, that also grew, that chunk of jobs. Let's go even further into the data. All right, so on the residential side, we saw that jobs in construction grew about 929.2 thousand jobs. So definitely we're seeing that bump that we've also seen in the data, in new homes data as well. So definitely a lot of jobs are added this month in June for both construction. Now let's move on to non-residential. These are schools, office buildings, hospitals, manufacturing facilities. So definitely an uptick there. That is a very good sign. So looking ahead. And then for civil engineering, that is the infrastructure jobs. So that is civil engineers, also boosted by the Jobs Act. So that came in very much positive. And then for residential specialty, definitely grew there for those are for residential and multifamily buildings, and for non-specialty residential specialty jobs, that also grew this month in June. So definitely a positive picture, Rochelle. Construction is there is a demand for construction workers in June. And if we take a look at this number, this is the non-residential specialty number. That really shows that, we've kind of seen the wonky headlines when it comes to commercial real estate, but there's still a demand for workers, especially in these, to build those luxury buildings. So definitely, Rochelle, even though those headlines could suggest something else, definitely in construction, it is a positive sign out there.
So Danny, connect the dots for us then. What do the residential construction job numbers say about the housing market?
So this report definitely was strong and shows that there is a lot of demand for construction workers, and specifically on the residential side. I mean, we saw new home sales really jump up in May. That really is signaling that the tight supply in housing is really pushing buyers to the new home market. So there really is a demand for construction workers. And also we need those. We still are undersupplied by 1.7 million homes, Rochelle, overall. So definitely, this is a positive sign that there is no slowing down in construction and hiring for construction workers. So definitely, this is really just signaling that we are moving in the right direction. The housing market has definitely rebounded, and these numbers are really coming in strong and proving that to be true.
So certainly, hopefully some light at the end of the tunnel for people who've been trying to get into the housing market, but still stuck with the lack of inventory. A big thank you there to our very own Danny Romero. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
What is a vibe session?
I didn't coin this term.
Okay.
But it's basically a recession that comes with lower consumer confidence, but where Americans don't act on it. They don't cut their spending.
So is it actually a recession?
Sort of. Sort of. It doesn't feel great, but it's where your pocketbook really isn't affected. It's just when things around you don't feel good.
And is that happening?
Not right now.
Okay.
I actually think confidence is up, but it happened last year.
Okay, got it.
Mike Channel.
Weather is weighing on America's aging power grid. Between 2011 and 2021, the average number of weather-related blackouts rose by roughly 78% compared to the prior decade. That's according to a report from the nonprofit Climate Central. And there are storm clouds ahead, literally. A climate event called El Nino has emerged for the first time in more than 4 years. That's expected to bring more abnormal and extreme weather events in the year ahead. Aaron Jagfeld is CEO of Generac, an energy tech company providing backup power systems for homes and businesses. He joins me now. Thank you so much for joining us this morning. So, talk about the season that we're going to be having this year and the sort of strain that we're likely to see on the power grid.
Yeah, thanks for having me on, Rochelle. So, your lead in there basically did a good job of outlining exactly what we see, which is, more extreme weather, right? The last decade, the last 2 decades, you could argue, we've really seen a lot more outages, and a lot of outages are driven by weather. I think what's changed here more recently, and as we think forward here and as we look to the future, is the extreme temperature swings, both hot, like we're experiencing right now, but also cold weather that is occurring in parts of the country that typically doesn't deal well with cold weather, like Texas had to deal with in February of 2021. Those types of extremities in terms of temperature swings are really having a major effect, frankly, on the stability of the grid. And this is really a broader discussion of the evolution of the grid as we work to decarbonize the sources, right? So we're replacing coal and natural gas-fired power plants with solar and wind at utility scale, and we can do that in a cost-effective manner. But of course, it's intermittent, right? So you don't have the ability to run those same assets 24/7 like you can a gas plant or a coal plant. And then on the demand side, we're racing to electrify everything in our lives. So our cooking, cleaning, cooling, heating, even transportation eventually, as electric vehicles continue to grow in popularity, these are all going to have a major impact on the grid. And trying to keep supply and demand in balance with these temperature extremes and these weather extremes, it's a major challenge for grid operators and utilities.
And as you mentioned, a lot of these developments weren't even a thought when a lot of these power grids were first being developed. So especially when it comes to electrification, how far are we from the investments in tech that need to happen to get us up to speed and where we currently are?
Well, unfortunately, the utility industry moves at a very slow pace, right? I mean, we're talking about really large, really complex systems. There are really 3,200 independent grid operators around the U.S. It's a highly regulated space, and of course, the individual grid operators don't always work together for solutions. So different solutions are evolving at different rates and different types of paces. But the reality of it is we're probably decades away from where the grid is kind of fully modernized, if you want to use a term, right? So some people call it grid 2.0. And that's going to happen. It's going to play out over the next several decades as the technology comes into the space. Really what we're doing is we're going to change the nature of the grid. Instead of delivering power from these central power plants to homes and businesses, a lot of times power is going to be generated closer to where it's going to be consumed. So whether that's a rooftop solar array on a home, or perhaps a local wind farm or a geothermal loop or hydro, those power sources are going to be consumed and produced closer to where the consumption is going to happen. So we're going to decentralize the power grid. So that's kind of the first order of business here. The good news is the technology is evolving. It's just the bad news is it's going to take a long time to apply that. And it's a very complex solution.
And do we know, will the costs of some of these upgrades to tech, will they start coming down? We know that with any sort of novel tech, everything can be quite expensive, as we saw with solar panels. Are we seeing, though, tech to improve the grid? Is that cost coming down as well?
Certainly for utility scale wind and solar, those costs have come down considerably as those industries have grown and as the technology's improved and scaled. But of course, some of the other technologies to deploy that, and then the resources needed to implement that, right? So whether you're talking about the installation of the solar and the wind turbines themselves, or you're talking about other technologies like battery technology, which is going to be a really critical technology that's going to need to evolve both in performance as well as cost here. Because again, as we said, solar and wind are intermittent sources. So really to make them more effective, we're going to need to add storage. And so that storage is probably going to take the form of a battery, some kind of chemistry. Today it's lithium ion. But that chemistry and that battery technology needs to go a long way before it is on par with existing technologies today. So the cost curve is we've got a long way to go in total. It's been estimated that to get to the modernization that we need for the grid, it's something north of a $4 trillion investment over the next 20 years.
I mean, so essentially you have the increased cost and the distance between where we are now and what the grid actually needs. And then factor in also El Nino season kicking off, which is going to affect everything from construction jobs, agriculture, a lot of businesses relying on some of this, consistent power. Talk about that economic impact and how you see Generac's role in this.
Yeah, I think you're hard pressed to find any homeowner or business that today doesn't rely on, a continuous source of power, right? I mean, you think about even in our own lives at home, the hybridization of work, right? People are working from home more today. Their kids are learning at home today. We're shopping at home. We're exercising at home. I mean, home has become the sanctuary as we've called it. And then of course, businesses are relying much more on technology, right? And you talk about technology that's in place today and technology that's coming in the future, like AI. All of this takes electricity. It takes electrons to make these technologies work and to make businesses operate efficiently and to make homes livable in the future. And so what's happening, at least for Generac, is that people are turning to the products that we manufacture, whether they be generators or residential energy storage or products that back up businesses. They're looking for resiliency, right? Because they know that outages are occurring more frequently. They're lasting longer when they do happen. And they're creating a lot more disruption, not only in personally for your life at home, but obviously the disruption that happens in a business. That's dollars and cents in terms of the impact. So what's happening is that homeowners are taking that into their own hands and business owners the same. They're investing in resiliency type of assets, whether, again, generators and batteries, things of that nature, so that they can protect those sources of power that are so critical to the way they run their business or the way they live their life.
You certainly have to have a plan when the weather is extreme weather being so unpredictable at the moment. A big thank you there to Aaron Jagfeld, Generac's CEO. Thank you for your time this morning.
Thank you.
Well, Mark Cuban's online pharmacy Cost Plus Drugs will soon offer a biosimilar version of AbbVie's blockbuster drug Humira. The biosimilar Yusimry will retail for a fraction of the price of Humira, once the world's biggest selling drug. Joining us now with more is Yahoo Finance's Anjali Kemlani. Hey, Anj.
Hey, Rochelle. Really big news for, of course, the rheumatoid arthritis community with this new product through Mark Cuban's Cost Plus Drugs. Now, we know that Yusimry is on the market already, and it is the list price is about $995 a month, but Cost Plus is going a step further. They are going to retail this for $569 a month. That's plus shipping and dispensing fees, but still about a 92% drop off of Humira's list price, which is $6,000 and something. So it's really a significant difference here that we're talking about. And of course, this is just another area where Cost Plus is really creating a lot of competition price-wise for these costly drugs. And especially now that Humira has all of this competition with biosimilars, Yusimry is just another one on the market, but really beating out what else is available.
And we certainly knew the writing was on the wall for Humira. So how does Yusimry compare to some of these other Humira biosimilars?
Really interesting to see the spread, actually. Most of them are actually retailing for about 5% off of Humira's price, but then you have Yusimry really on the other end of the spectrum, 86% of a discount compared to that, while two others are in that 85 range, so pretty close there. But a majority of them, like I said, about 5% of the discount. And it seems like even though there are a few others that are expected to come onto the market this year, that seems to be sort of the bulk of where the competition comes from. Now, we know that these prices are, of course, the list prices, so where the coverage comes from. And of course, some of them offer copay options and some of the help options that basically set them at zero. So it's quite a varying field. We also know that PBMs have taken an interesting stance on this, listing Humira on the same tier essentially as all these others. So making it a little bit easier for folks to continue to prescribe Humira alongside all of these others. So what that actually means in terms of the impact for AbbVie, we'll certainly start to see that this year. So basically stay tuned for their earnings. That's what I'm going going to be watching and I'll let you know once we know.
I mean, 86% off the list price, that's gonna start pinching. But as you mentioned, we'll have to start looking at that earnings data when it comes in. Great stuff. Thank you so much for that update, Anjali. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Investors will decide when the AI bubble bursts. And here's what we mean by that. As you were just citing, some of the analysts that are turning a little bit more sour on the traditional AI plays that have been out there, largely in the form of where companies can get in on the LLM, the language learning model side, or even on the chip side. We've already seen chips absolutely skyrocket, and it's kind of framing one of the stories over the course of this year. And then additionally, I think right now for investors, they're going to have to consider what is the price that we're not willing to pay for this, and where we're going to be monitoring the timeline for what companies promised and how they're going to actually deliver on some of the AI promises into their bottom line as well here. So I would say Q3 2023.
Q3, yeah, I feel that. And I also think investors and users need to see how this plays out, right? Like, there's still a lot of unknowns here. So TBD on that.
Shares of Levi Strauss are ripping at the seams this morning after the retailer took a hit from a decline in U.S. sales, down 22% year over year, and slashed its full-year profit outlook as it battles a difficult consumer landscape and climbs back from high inventory levels. Harmeet Singh, Levi Strauss and co-CFO Chief Growth Officer, joins me now this morning. Appreciate you taking the time to join us this morning, Harmeet. I mean, we're seeing investors really honing in on... Thank you. We're seeing investors honing in on this full-year guidance, and especially on that softer wholesale aspect as well. Break down the reaction that you're seeing from investors and how justified you think it is.
Sure. First, thanks for having me. A bit of the backdrop. We came into the year expecting this year to be a tale of two halves, with the first half a lot weaker than the second half, essentially because we were lapping strong growth from a year ago. We were implementing an ERP, and commodities, cotton in the first half was pretty high. And a tale of two worlds, with the Western world slightly softer, the Eastern world and Latin America fairly strong, and a tale of two channels. Our direct-to-consumer business, which is our stores and e-commerce, and the best expression of the brand, strong, with the wholesale business largely weaker. As we exit the first half, a couple of things. We have delivered on our quarter two commitments and our largely first half commitments. We were up, we were flat to a year ago, but up 10% relative to 19. The headwinds, like the ERP is implemented, commodity pressures have abated, and the second half is being set up much stronger, as well as our direct-to-consumer business is up, double-digit on top of double-digit growth from a year ago. Going back to the question about the full year guidance, as we exit the first half, we have grown market share in the U.S. Men's is up, women's, where we were, number 3 a couple of years ago, we're number 1. And we're taking actions to address U.S. wholesale. We're taking some surgical, price reduction on a handful of fits. Our supply chain has got a lot more efficient, and inventory levels have come down dramatically. And, we said we'll end the year with inventory levels below last year levels. And so we're basically setting up, 23 and the second half, where we will grow mid-single digit and exit 23 in a much stronger position and laying the foundation for a strong 24.
We know that a lot of us, investors, they were looking at that data, but they were also a little bit concerned about that net loss for the quarter of 1.6 million. Obviously, something we hadn't seen since pre-pandemic there. So in terms of the long play then with direct-to-consumer, is that still going to be the committed focus there versus any more reliance on third-party sellers?
Yeah, as we've expressed strategically, our direct-to-consumer business is today about, a little over 40% of our business. It was, half this a decade ago when Chip and I joined. And our slated goal is for this business to be the majority of the business going forward. We have great retail customers, and so the company is going to be a hybrid company from a channel perspective and actually grow distribution with both customers. But the direct-to-consumer businesses represents the full expression of the brand. The chambray shirts that I'm wearing, the denim bottoms, a non-denim business, etc. If you go to our stores, you find, a head-to-toe look, as well as, the interaction and engagement with store staff, the tailor shop, etc. is how, why we believe the consumer engages a lot better in our direct-to-consumer business, as well as our e-commerce business, which was up 20 odd percent this year and is still under-penetrated. So to your point, and in the U.S., Rachel, our DTC business is still strong. So it's a tale of, two channels in the U.S. Our direct-to-consumer business fairly strong, U.S. wholesale business weak, and we're taking actions, as I said, to actually address that so that we exit 2023 with a more stable U.S. wholesale business and a continued strong direct-to-consumer business. Our international business, which is outside the U.S., is really strong. It grew, 10% if you adjust for Russia. And that business is now close to, 60% of our business and growing. And our view is, that will continue to grow. Between DTC and international, they are higher growth and higher gross margin business. So from our perspective, definitely impact the structural economics of the company positively.
And I want to also ask you about the state of the consumer. Consumers, they're looking for value plays, and we're seeing that across the board here. And we're looking at Levi cutting prices for roughly 10% of U.S. wholesale styles in Tier 3 wholesale accounts. What about some of the other models, perhaps on the DTC side or with the 501 denim models as well? Can we expect to see more price cutting there?
Yeah. So the answer is no in terms of price cutting across what we call our core and premium expression of the brand. So just a few facts on the price reductions, which were targeted and again against a handful of fits. They were largely driven by the fact that we're seeing the value conscious consumers earning less than 100,000 become a lot more price sensitive. And as we thought about actions, we said there are a handful of fits where we have taken pricing over the last couple of years, and we need to adjust that. But as you think of the U.S. landscape, we have over 120 fits. We are taking pricing actions on 6, so it's about 5%. Wholesale is over 60 odd fits, and we're taking actions on 6. We're basically not touching the majority of a line. They provide great value to the consumers. We do brand equity studies on a regular basis, and price value equation for the Levi's brand, both here in the U.S. and outside the U.S., comes out fairly strong. And that is because we deliver quality products, the relevant products, both for him and her, and that's being borne out by the market share growth. And so our view is these actions, including ensuring that when our customers orders, they get the product on their floor. And so when the consumer walks into a retailer, he or she gets the product. And we're seeing a major lift as the stockouts abate. And I think that's going to be a big play in terms of how we drive improved execution in the U.S. wholesale business in the second half of the year.
And what do you think is going to be the biggest selling point for Levi going forward? As you mentioned, sort of, tight spending here, still waiting for some of those inventory issues to work themselves out as well. What do you think is going to be the biggest selling point for Levi for the second half of the year?
Having the right product on the floor, a lot of newness. You talked about 501. We're celebrating the 150th anniversary, of the launch of the 501. We created jeans and denim, and we're celebrating that. And so you're going to see, a lot of newness on the 501 in the second half, especially as we gear up for back to school and the holiday season. The second is improved execution. When somebody walks into our store, you get the product you're looking for, you get the size, and that's really improving our fill rates from that perspective. And then with a slight adjustment on prices, again, a better price value equation. So if he or she really wants, either a denim top or a denim bottom or a non-denim product, they're going to come and shop at Levi's. And we have other brands, Rachel. We have Beyond Yoga, which is, doing really well. Dockers, doing well. And so, our perspective is we want to own a higher share of your closet and become the best apparel company in the world. And so we're gearing around, meeting that long-term mission or vision.
I've never been brave enough to do the whole Canadian tuxedo, the denim on denim for the shirt and the jeans. Maybe I'll give it a try. A big thank you for joining us this morning on Yahoo Finance. Harmeet Singh, Levi Strauss CFO and Chief Growth Officer. Thank you so much.
Thank you, Rachel.
All right, all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
Do we think a recession will happen this year?
So we don't know, but we know that expectations seem to keep getting pushed further and further out. And one of the things that I wrote about this week was a note from Credit Suisse that says the recession won't actually start until the yield curve uninverts. And right now, futures don't put that until 2026, which is pretty incredible.
We'll see. And I'm going to say no. I'm going to step out and say no. The economy's been stronger than we thought, and I think we can push it out another 6 months.
Welcome back to Yahoo Finance. I'm Brooke DePalma alongside Eugene Rem, Catch Hospitality Group, co-founder and partner. We're here at Catch Steak, New York. I mean, the June jobs report came out this morning. We're slowly seeing jobs come back post-pandemic. What are you seeing at your locations?
What we're seeing is that we're fully staffed, and that's been the first time in about 2 years. So the key to greatness for restaurants is consistency. And from 2009 to 2019, we were just consistent, right? Post recession, we just went straight through of constant growth. So you're able to staff accordingly. But a pandemic just absolutely changes that. So you yo-yo from being completely closed to only takeout to 20% to 50% to closed again to 20% to 50%. And that really makes it challenging for people to have consistent work. So a lot of people left the urban markets because, I mean, you can't really afford to live here if you can't work here. So it's been a real challenge. And I think for the last year and a half, most restaurants have been operating at probably 60, 70% of where they're supposed to be, which is why maybe some people have had challenging services at some restaurants. It's not because the restaurants are poorly run. It's just because it's been incredibly challenged to get staffed. But in the last 3 months or so, we've finally gotten to a place where we are completely staffed. And that's important because once you get completely staffed, and we're talking about like line cooks and line level employees, now you could focus on not just filling the role, but actually getting the best people for the role and making sure that you're elevating those people. So that's been a breath of fresh air to see, and glad that, you know, the crypto market isn't great, so these people can't day trade, and maybe the gig economy isn't working out as well, so people are coming back to work, and that's really exciting.
Yeah, and right when you finally catch a fresh breath, so to say, I mean, you're also opening in Dallas, you have another location opening. What sort of incentives are these line chefs, top chefs, hostess, waiters looking for, and how are you maintaining that talent once you get it in these new markets?
Great question. So we always just say we want to promote from within, and we amplify that message, and COVID really made us do that. So we always say no glass ceilings, and everything is a platform for growth. So our goal is we're probably going to have to hire 1,000 people in the next 2 years for the 3 stores that we are opening in Miami, Dallas, and another location. And our goal is to hire from within. Our goal is to offer every single person that's working in New York an opportunity to go to Miami, every single person in LA. And we hope that we can grow because we need to create and maintain the culture. And that's something that you can't just create by putting people in a job. So we work really hard, and it's not just paying people. You really need to, they need to believe in what you're doing. They need to be curators of experiences. We focus on 3 pillars: great food, great service, and great vibe. So they need to believe in all that. So if they're listening to the song while they're working, we hope that they enjoy it, because it's not just about the money.
Yeah, let's talk about the customers that are heading into your restaurants. Inflation has been taking a toll on Americans' wallets across the board. Food services inflation is up more than 8% as of May. Where are you seeing sticky inflation? You make all your food in-house, so what's sticky still?
What's sticky? Well, I think it's important to remember that I think that the food experience has completely been underpriced for a long time, and you're not just paying for food, right? We all lived at home in the pandemic and cooked something on our grill and then put it down on our plate. You don't get the full experience, right? The 3 elements, which is food, service, and vibe. So I actually think that food's been underpriced, and I think that the price increases have been fair to what we need to do to survive, because you would never be able to pay $100 at home to have that full experience. You'd never be able to afford the plates and 7 different plates for 7 different dishes. You wouldn't be able to afford the entire experience. So $100 for 2 hours of a full experience, I think of it like a night out, and I think it's a fair price. But look, everything does cost a little bit more, and what costs us more, we then have to make sure that we're still making the money that we need to make. So everyone's spending a little bit more, and that's just, I think, what it needs to be.
Any certain foods that you're seeing the highest price points on?
I've seen things actually been dropping a little bit. Like there's certain things like lobster, which is super expensive, and crab, which is super expensive. And those items, you just sometimes have to take off crab. And people look at it, and if it would be, the prices have tripled, right? So if you used to pay $10 for a specific item, it would look really strange to just pay $30 for it, but that's what the cost has become. So we make decisions every day, and we sit together with our culinary team and our operations team and our corporate headquarters at Fertitta Entertainment in Houston, and we look for where we can find that balance to give the customer value without crushing the business.
Right, and when you think about that average customer that you're seeing, what sort of income cohorts are you seeing, and how often are they dining out?
Well, when we created Catch, it was super important for us to make sure that it was accessible to all. So we consider it affordable luxury. So if you're aspirational and $100 check average is something that you can't reach on a regular basis, we try to get you for a special occasion, a birthday, and an anniversary. And if you're a business person and you live in New York and that's just your night out, then that's your affordable night out. And we try to really hit every single type of customer, and that's what makes Catch special. Something that makes New York special is you connect with not just people who are of the same financial class as you, but you reach everyone. So we try to find that sweet spot to get, if you have $60 and that's what you have to spend and you only want to have a glass of wine and 2 sushi rolls, we want to accommodate you. And if you're on a big budget and you're doing something really special and you want to spend, then we have those items as well. So we try to meet our customer wherever they are.
Eugene Rem, Cash Hospitality Group, co-founder and partner. Thank you so much. Stay tuned for more on Yahoo Finance.
What is a vibe session?
I didn't coin this term.
Okay.
But it's basically a recession that comes with lower consumer confidence, but where Americans don't act on it. They don't cut their spending.
So is it actually a recession?
Sort of. Sort of. It doesn't feel great, but it's where your pocketbook really isn't affected. It's just when things around you don't feel good.
And is that happening?
Not right now.
Okay.
I actually think confidence is up, but it happened last year.
Okay, got it.
Welcome back to Yahoo Finance Live. Well, the U.S. economy adding 209,000 jobs last month, below expectations. We had the unemployment rate dipping just a bit to 3.6%, but wages, that key metric there that we know the Fed is watching very closely, coming in a bit hotter than expected. So what does this all mean for the Fed, and what's it going to take for the Fed to change its mind or hold off on future rate hikes? We got the all-star panel here to break it all down. Miles Udland, head of Yahoo Finance News, here with us. Sam Rowe is back in the building, former managing editor of Yahoo Finance, a co-founder of the ticker, and Ann Berry is here with us, Threadneedle Strategies founder. So, Miles, let me kick it over to you first, just in terms of how the Fed is looking at a number like this. And I think the general consensus is still way too hot for what the Fed wants to see.
Yeah, well, we saw basically no reaction in Fed funds futures after this number because we kind of know the Fed is going to raise rates in a couple of weeks. And I think my question coming out of this, there's like on the one hand, you have the headline, which is, oh, jobs report misses. First time in 14, 15 months, I guess, that we've seen a miss relative to expectations. And to me, the question is, what do we need to see? What would we need to see from the labor market that would make the Fed change its mind and change what I think, and I'm curious in your thought on this, what I think is a pretty firm outlook on what they're going to do. Powell has said, here's how we're going to proceed the next few months. And I think the market believes him, clearly based on the pricing. What would we need to see in the labor market to have him kind of change his tune?
Well, the market believes him finally, Miles, right? It's taken the ECB forum, it's taken a testimony on the Hill to get them to finally listen to what he's been saying all along, which is the data is looking, it's like it's going in this direction. And here we are. He's been like a parent having to repeat something to children over and over and over again, and that being the market finally is listening. I do think it's
familiar with that.
I think one of the things that we forget, Miles, is that the Fed has actually got a dual mandate. It's got to bring inflation down to that target at the maximum employment it can to hit that number. So I think at this point it's getting that wage inflation down. I don't think it's the unemployment rate, it's the wage inflation piece that needs to move.
Sam, how much, weakness do you think we are expected to see? If we do see 2 more rate hikes from the Fed, is that going to do it? Will we see that then eventually reflected in the labor market, or that's higher for longer narrative seems like it's here to stay, at least for now?
Yeah, I don't know. I mean, so the unemployment rate climbs to 3.6% or whatever, and it's like, down from a month ago, but it's up from its 60-year low of 3.4%. So the unemployment rate is still extremely low. So that gives the Fed a lot of room to continue to make moves on monetary policy and interest rates and all this kind of stuff. But when you look at broad measures of inflation, like the CPI report and core PC and all these things, they've all been trending lower for months. So I don't know, directionally things seem to be going well for the Fed, and the fact that unemployment rate hasn't really budged and we still continue to get 200,000 plus job gains per month tells me that they have a lot of room to continue tightening.
And I think another question that kind of comes out of this jobs report and bigger picture, and like the story last week was the Bears finally have to give it up. Okay, the economy is doing well. Not only is the economy hanging in, but we're starting to see acceleration in some pockets. Housing is a big one. And we saw a little bit in the minutes on Wednesday, an acknowledgement from the Fed that housing might not be in the tank. Powell has, for months and months been like, housing is, depressed, this, that, the other. The stock market has disagreed with that for quite a long time. And you kind of wonder now if this jobs report is in service to the actual thing, the soft landing that so long ago was really mocked by, when Powell says things, everybody mocks it. But, your peers in the industry who were like, I believe in a soft landing, they were probably not having fun conversations with clients either.
Yeah, I think that's exactly right. And it's interesting on manufacturing specifically, and talk about the pockets, right? Manufacturing is the piece that looked like it's been heading into recession territory. But if you look at the jobs report today, that's actually where you see some pop, some uplift in actual job growth. I think in terms of the recession outlook, I've been one of those bears. I'm like waiting for Godot. When's it coming? When's it coming? It hasn't come. But the thing I do think is still something to watch is it's not just rates that the Fed can impact and that impacts the consumer, and this economy is built on the consumer. It's also credit availability. And one of the reasons I remain a bear is I do think there are credit issues coming.
So when you say you remain a bear, what is your outlook maybe for the next 6 months, but maybe let's do 18 months? What sort of, I guess without putting numbers on it, it's what sort of downturn in your view does this economic setup portend us likely heading towards? It can always change, but consumers being crunched on credit is not quite what we saw in COVID. That was just sort of this labor market panic. I mean, is this something that you think may be more protracted as these forces come through balance sheets?
Well, I think we're in this window. Let's take the terrifying 18-month window, right? Where
No numbers, it's fine. No numbers.
But a couple of that is going to be a window, I think, of a real realignment, right? I think we are going to see rates higher for longer, not just because we know the Fed's not bringing them down anytime soon, but because new debt is going to be issued now that locks in today's rates for a period of time. And that's going to create a stickiness as well that I think reins in not just consumer spending, but corporate CapEx budgets, right? Industrials figuring out how to spend. The return on those investments are going to go up because you can otherwise put things in a risk-free, hold treasuries. So I think there's been I think it's going to be a bit of a step function. And I think it's going to be lower than where it's been.
Yeah, and I think that's a really good point. You bring up the CapEx there for corporations. And Sam, I know you've recently written about this, and we have so much focus on the Fed. Obviously, earnings, a lot of that resulted just in terms of the guidance, the focus that's going to be on guidance here in this upcoming report, result of what the Fed is going to do with rates. But in terms of determining the direction of the market here going forward, how much, I guess, more are investors looking at those earnings results and what that could portend in terms of future action?
Yeah, I think that's a really good point. And to Anne's point, this question about higher interest rates and tighter credit conditions and higher credit costs and all these things are huge concerns. But one of these things we did see with corporations, there was a lot of refinancing happening in 2020 and 2021 where they were refinancing at lower rates and pushing out maturities on a lot of this debt. So, maybe rates are higher when they do have to refinance a lot of that debt, but they have a little bit of time there. And if there's one thing that we've learned from earnings season, we're probably going to learn it again this earnings season, is that corporations have had a remarkable ability to keep their profit margins high. And with profit margins near record levels, that also gives them some flexibility to take on some higher interest costs. So, and if there's also another thing that we've learned from this pandemic era with corporations, is that even with stuff like rising inflation, rising costs, difficult logistics to execute business, they still manage to figure out a way to keep profitability very high. So I don't know exactly how it'll work in 18 months or when this debt has to be refinanced, but you sort of have to wonder how corporations do get creative when it does come to confronting those higher borrowing costs when those bills come due.
And I think another question for me, Sam, is like, okay, what is the stock market reacting to then? Is it reacting to, so you're kind of outlining this situation where corporates are in a healthy place, where they do have a little bit of wiggle room on the balance sheet, they have wiggle room I think probably with their staff as well. There's been basically nothing happening in the M&A market. You can make these moves around the edges. Is like looking towards the end of this what the stock market is reacting to? Or is it just like everyone said AI on their earnings call, so you should bid it up 20% and call it a day?
Yeah, I mean, it's probably a little bit of both, but a lot of the concerns that we've been hearing about headwinds to the stock market, including this earnings recession that is very much expected by everybody. And everyone's been talking about how the economic recession that has yet to come is the most talked about recession in history. But the earnings recession for corporations has been similarly talked about for months. And here's what happens when that time passes with those months. If we're talking about an earnings recession in Q2 of this year, a year ago, then it's like you're looking forward. We're past Q2 now. We're still talking about this earnings recession of the past. So to your point, Miles, I don't think while we're going to continue to hear about how earnings were weak in Q2 and maybe weak in Q3, the market is looking forward 12 months ahead. It's always looking forward, right? The stock market, stock prices are discounting mechanisms. And the outlook seems to be a lot rosier than what we're facing now.
But how much of that risk do you think, Anne, has already been priced in when we talk about future rate hikes, the fact that earnings could potentially disappoint here for this quarter and going forward? We haven't necessarily seen that earnings recession, but how much of that has already been taken into account, and then what that downside pressure could look like if not?
I think the coming to the end of a cycle isn't yet. It's sort of, I think it's what's kept us buoyant so far. I think actually there hasn't been enough pragmatism going the other way. The earnings recession risk that I worry about, I have a different perspective from Sam on this actually. Am I allowed to have a different perspective from Sam?
Of course, it's always good to have a debate.
Part of the reason that corporations were able to keep their margins strong was because they were playing off inflationary expectations, right? If you guys were hearing prices are going up, input prices are up, supply pressures are there, you're willing to eat price hikes. Now you've got to say to the food companies, the apparel companies, knock it off. knock it off, right? Inflation's coming down. You can't keep hiking prices. And by the way, my wages, yes, they're still a little too hot inflation-wise, but it's clearly not going to keep going if we believe the Fed is going to do what it's going to do. So I think a lot of that margin cushion was created by inflationary expectations or animal spirits. Let's get Keynesian about it. And it's going away. It's going away because people are now beginning to believe the market. That's where I think the downside risk is.
And I actually completely agree with that.
Don't.
I completely agree with that, and I think that's what makes the outlook so murky. Because one of the reasons why, consumers have been, as much as they hate inflation, they've been paying up for it, right? They're, you only ever hear about people complaining about airplane tickets after they buy the plane tickets, or it's like, oh, Disney World tickets. It's like, I was at Disney World and I paid this much, right? So it's like, it's because they had money. It's because of all this fiscal stimulus that they're still sort of, spending off, this excess savings number that we keep talking about, and all this stuff is starting to dwindle. So I definitely think that, that's helped, and, there could very much be pushback from consumers, especially when their finances get a little bit tighter. So I think there's absolutely uncertainty out there.
So then in thinking, maybe coming back to the corporate point on that, and about how corporates think about setting up, their pricing structures and the things that they might want to do to their customers, did we not then enter like this new era of essentially the relationship between suppliers and buyers and what expectations are on the corporate side for where your costs could go? Like, was there not a big reset out of COVID? Was it a one-off inflationary period? People took price, people, tried to refill their inventories very rapidly, and now we're back to, I don't know if it's business as usual or, whatever that cycle was, that long moderation, great moderation we saw in the 2010s. Are we trending back towards maybe that environment on the corporate side?
I think we're heading back towards normalization, but I think the excuses that corporates had, other than wage inflation, have gone away, right? If you think about what shipping costs did during COVID, they were absolutely astronomical. And everyone said, okay, well, if I want my product, I'm going to have to eat the cost of air freight. That's gone. It's the wage inflation piece that is tough. But I think where the market is going to have less patience now is if management teams say, well, look, we've got margin compression or we've got to put prices up. Unclear if that's going to go through because wage inflation is high. I think at some point the market says, okay, you CEOs and executives, you know this was coming, you've seen the trend for a while, you had to manage for this. And if you're not getting it on procurement, if you're not getting it on productivity gains, you're not doing your job. So I think patience is going to run out.
And so I think that's also your last point there, I think that also speaks to the other side of the uncertainty to the upside, right? You have to offset this with productivity gains. Yeah. And AI is just sort of a catch-all for all this. But there is a lot of things going on with AI technology, and there's a lot of actual orders for this technology in place, right? And that also goes back to what we're talking about with CapEx orders. There's still a huge backlog of core CapEx orders, or however you want to call it, but there's a lot of business investment that's still going on. And that's also going to replace a lot of old equipment that was less efficient. So with the, whether it's AI, whether it's new machinery, whether it's, people with different kinds of skills coming in, there's potential upside there in terms of productivity gains to offset what might be lower margins because you're not able to pass things off through price.
Certainly. Well, we got to leave it there. There's a lot more to discuss. So, Ann and Sam, you guys got to come back to 770, back to the office here to continue this conversation at some point. But thanks so much for watching here on Yahoo Finance. We'll leave it there for now. We'll be back at 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. See you then.